Guys, we're in a new financial year. 2025, the financial year has just ticked over, and one thing I often hear from my clients is, I'm thinking about buying an investment property. And the reason they're thinking about that is because a new financial year, just like a calendar year, when it ticks over, a lot of clients, a lot of people just in general think about resetting their goals. And it's a great time to reset, think about what you want to do. But today's podcast is all about providing information for you on 5 vital things you need to know about an investment property. We're going to go from the basics right through to a bit more of advanced knowledge.
If we're not growing, you're not growing.
So today's podcast, we're going to talk about what you need to know initially about buying and finding that rental property. We're going to talk about what is negative gearing. Is it really worth it, or is it just a whole lot of hype? The next thing I often hear as well is, who should be the legal owner? Should it be my husband? Should it be my wife? Or should it be in a trust? And we're going to talk about how generally income expenses work in the tax return itself. And then I'm going to talk about how to maximize tax deductions in your investment property. So before we get going today, if you are new to the channel, welcome. I want to introduce myself. My name is Nathan Rigney. I'm the profit generator, and I am an accountant. I am a CPA. I'm a certified profit first professional, and I'm all about everything in basically small business to taxes to being able to find financial wealth and basically having a life that serves you instead of you serving everyone else. So that's what I'm all about. Health, fitness, I love it all. So that's a bit about me. If you're tuning in week after week, I just want to say thank you and welcome back to the channel. Before we get into today's podcast, I also just want to throw out there just a very general disclaimer and just remind you that everything we talk about today is just general in nature. I don't know your personal circumstances, so take the information, soak in what you can, and then go and see your accountant, go and make an appointment with myself, or see your financial planner and sit down with someone who's licensed to give you the information, where they can find out information about you and your personal circumstances, and then get information that's tailored to you. So just remember, everything today is general in nature, and you should soak up as much as you can, but then go and seek out a professional. So the first thing I always talk about when a client comes in wanting to buy an investment property is, hey, where are you going to buy? And that is so important. Are you going to buy what type of property? Assuming it's in Australia, right? Is it going to be a unit? Is it going to be a townhouse? Is it going to be a house and land package? What I usually say to my clients is that generally you don't have a real lot of knowledge about prime property. You've probably bought your own family home. Maybe you've bought a few homes in your lifetime and now you're at a stage where you can afford an investment property, but then knowing what you're going to buy is so vital. And I guess what I do often share with my clients is stories I've heard from other clients in the way they've invested and bought properties. I remember there was one client I had like over 20 years ago. They bought an investment property. They held this property for 10 years and did not make one single dollar. And it all came back to the research they did initially to buy the property. They bought a property that was a unit. It was by a developer who was shonky, and this property always had repairs needed done on it. They paid so much more than what they should have. And all they were thinking about back then was this initial, negative gearing, we're going to get bigger refunds. The reason I'm sharing that story is it's so important about what you buy initially, because the ultimate goal should be that, yes, you want the rent to be able to pay down the loan, the finance you're going to be borrowing to buy the property, but also you want to have that capital uplift. So if you buy the property for, say, $800,000 today, in 10 years' time, you want to be selling it, say, for example, $1.8 million. There needs to be a uplift of that capital growth. And if you don't buy the right property to start with, or you're going to the wrong people to help you buy it, you could be paying overs or not even buying a property that's going to give you that return that you want based on the risk that you're taking on board. And so what I really look at is, and what I often say to my clients is that, you know what, you're really good at what you do in your day-to-day job. And as much as you might know about property in your own neighborhood, and you might be thinking, hey, I want to buy a property I can go visit, you've got to shift that mindset around going, maybe we've got to do something a little bit different. So I often refer a lot of my clients to a buyer's agent. And what a buyer's agent is basically is they are a licensed real estate agent, and instead of them selling properties, they actually go out and find properties to buy. And what a good buyer's agent should do is they should be doing a lot of research about location, analysis on rental demand, being able to forecast what is going to happen in a particular area in the next 3, 5, 10 years time, or even beyond that, to go, well, understanding what's happening in a particular area to then project or predict what capital growth you're going to have in that said location, right? So the reason you want to use a buyer's agent is because they're doing all that research, and the reality is that even with the fee that you pay a buyer's agent, it's going to be worth so much more than what you're going to put in as far as time. So if you have to do all this research yourself to buy one property, you don't even know if you're going to get it right. But then also, you're going to be doing it on the side whilst you've probably got your full-time job, you've got the kids to look after, or whatever else is going on in your life, right? It means that you can get a professional to look at it. Now, when you are thinking about getting a buyer's agent, you've got to be very careful about, like any industry or any professional, any person that you employ or contract to do a job for you. You've got to do your due diligence, you've got to have a look at it. And sadly, to go get your real estate agent's license, it's not that hard. I don't know exactly how long it would take, but I know that if I wanted to today, I could probably go get my real estate agent's license within about 6 months, and I could call myself a buyer's agent, right? But the reality is you wouldn't want to employ me to go and find that property for you, because all I can say is that I've bought my first home that was a unit, and I sold that and bought another property, and the only properties I have are the properties that I've lived in. And typically what you do see, and what I have seen myself out there, is that people are going through these courses saying they're buyer's agents, and maybe they bought their own investment property and really have a desire and love for rental properties or property in general, but to then go to that extent to go, hey, they're working for themselves and they're going to find you the right property that's going to give you that capital growth, might not happen when they don't have a lot of experience. And the buyer's agent that I refer to, his name's Glenn Newbury. So shout out to Glenn. He's from Suburbanite and he is with a big team. And that team have bought hundreds of properties, like thousands of properties. Glenn's buying a property once a week for his clients. So he's got a lot of experience and a lot of knowledge. And in fact, a local real estate agent client of mine who I introduced to Glenn, and Glenn helped him buy a property, that real estate agent client who works in the area I'm in was like, I actually learned a lot of things from Glenn as a buyer's agent, right? So that says a lot to you. Someone who's actually in the game of real estate learned something else from a buyer's agent. So it comes down to experience. It is so important. And the reality is that when you're doing this, they're going to have a lot of experience when it comes to negotiating. They're going to know off-market deals. And they're also going to help you avoid that emotional piece when it comes to buy a property. Because remember, the reason you're buying the property is, and look, I don't know what your goals are why you're buying a property, but generally speaking, a lot of people want to have that increase of capital growth. They want to increase their personal net worth. And if you're going to buy a property that's going to go backwards or not even have enough growth in it, you're going to be going backwards. So I always think that a buyer's agent is the best way to go about for actually finding a property and buying a property. The next thing as well is before you go and even have these discussions, you want to have a really good mortgage broker that can help you determine how much can you borrow before you then go and speak to the buyer's agent. So really have those two people together, have a conversation, do your homework initially, and have the right people with you to help buy that property. So getting a buyer's agent and getting a really good mortgage broker, working those two together, and even speaking to your accountant, put those three together, you've got your dream team to find the investment property that's going to serve your purpose of increasing your net wealth. So the next thing I often hear from clients, and I think it's died down over time, but negative gearing. So let's just talk about what negative gearing is first. Negative gearing is basically saying that you're going to make a loss on your rental property. So that means that with the rent, less all the expenses, the interest on the loan, and maybe depreciation on the property, the best way to describe depreciation is the wear and tear over time on big items within a property. So you're going to have basically at the end, when we look at all the rent less all the expenses, you're not going to make any money on paper. It's going to be negative. It's actually going to cost you money to have that property. And so the way it works with negative gearing is that you can then offset that loss against your income. And so what I mean by offset is it's essentially a tax deduction. So if, say, for example, you had a rental property where the total loss was, say, $20,000, if your income was $120,000, that $20,000 comes off as a tax deduction, and now you're getting taxed on only $100,000. So you imagine that your employer has now taken out too much tax on your wages, and so because you have that $20,000 reduction in your income, you're going to get a refund. And so what I guess clients do, people who are investing in property and doing negative gearing, is they're using the taxes they would have paid, they're using that to then put towards the loan and help pay down the loan quicker. So the next question is, when does negative gearing make sense? To me personally, I think that negative gearing is not as good as it's cracked up to be. And the reason is this. So with negative gearing, what happens is, if we look at just, say for example, the interest component on your loan. So even if you just did an interest only loan, it means that you need to take money out of your own pocket to then put into this investment property. And so when we talk about income tax, yeah, sure, for every dollar you lose, you get whatever your marginal tax rate back as a tax deduction. So as an example, if you're sitting on the middle tax bracket, which is 30 cents per dollar, if you lose $10,000, and so what do I mean by lose $10,000? So let's say, for example, your negative gearing came down to $10,000, and part of that could actually be, a good chunk of that is usually interest, right? So you've had to pull out of your own pocket $10,000. Let's say, for example, you put $10,000 towards all the other expenses to then keep maintaining that property. Now, sure, when we do your tax return, you're going to get $3,000 back because your tax rate is 30%. Obviously, if you're on a higher tax bracket, if you're on, say, 45 cents, you're going to get $4,500 back. But in a scenario where you are getting that tax back based on your marginal rate, it also means that if you lost $10,000, you had to use your own cash to then support the property. If you put $10,000 in and your tax, all you got back was $3,000 based on 30%, or let's say 45 cents for $4,500, it means that you've had to essentially, after the $3,000 refund, it's actually cost you $7,000 or about $5,500 if you're on the higher tax bracket. Now, I would rather have a property that is actually making money and is what we call positively geared. And so what we mean by positively geared is that after all the rent, all the expenses, it's actually got a profit and then you're paying tax. So if I had a rental property where it made $10,000 and my marginal tax bracket is 30 cents, I'm going to pay $3,000 tax. But then, because I made $10,000, I now have $7,000 left over, which I'm then going to use to actually pay down the loan. Or if you're on the higher tax bracket, it might mean that, hey, you're paying $4,500 in tax based on a 45-cent marginal tax bracket, but you've now got $5,500 to put towards the loan. So I always think it makes sense to have a positively geared property and not be reliant on the negative gearing to help you get you through. I don't think negative gearing, to me, is what I would be going for. I'd always be trying to find a property that is geared to work towards being positive and actually making income. So the next question I often get from clients is, who should actually be the legal owner of the property? And typically what we look at is there might be one partner in the family who's a high income earner, there might be another partner who's maybe not earning as much money, and then the option of going, should we own the property in a trust? So what is a trust? We'd be talking about like a discretionary trust, like a family trust. And if you go back through some of my prior videos, there is a video that explains to you what a trust is. But effectively what a trust is basically saying, when that rental income is there, it can then be distributed to family members at the discretion of the trustee, which means that you can essentially put that income towards the partner or the wife or the husband, whoever is on the lower tax bracket, or maybe someone in the family that's on a lower tax bracket, which then saves you some tax. But the problem is, if you're buying a rental property and you are borrowing money for it, the reality is it might be hard actually getting the finance in the trust. But then second thing as well is, if the property is actually making a loss, you can't distribute a loss in that property. So that is one issue that I can see in holding a property in a trust. The next issue is that depending on where you buy the property, and what I mean by where, I mean by what state in Australia, is that there are different taxes that apply for holding a property in a trust. As an example, for New South Wales, if you hold a property in a discretionary trust, the first dollar of that property gets taxed for land tax purposes. Whereas if the property is in a person's name, there are thresholds that need to be met first before land tax applies. So this trust is one option. If, say, for example, you're thinking about having it in your name and maybe you've got a higher income. The property could go in your name to start with, depending on your circumstances. But if you know that the property is going to have a loss, that would be quite beneficial, having the property in your name, being the higher income earner. But the problem is that, say for example, when the property turns around from being negatively geared to positively geared, means that now it earning income and getting taxed, then when it gets to that point, that then you're already on a high tax bracket, so whatever money you're making is going to get taxed a lot more. Whereas when the property is losing money, there's a bigger tax benefit. And so I guess what you need to look at in that scenario, and the flip side is if you've got the partner that maybe isn't such a great income, they've got that loss to start with, if you know that it's going to be negatively geared to start with, then you might not want it in their name. But say for example, you need to know that negative gearing is not going to happen for a long time, and it's going to be positive and start earning a lot of income, maybe it's better being in the person's name that's on a lower tax bracket. But effectively, what you need to look at is you look at your circumstances as well, and then apply that basic understanding and say what works best for me. But the one thing that I tell you what, when it comes to the legal owner, you got to think about as well, like the end point. So at some point you're going to want to sell the property. And so if it's in a trust and there is a capital gain, when you distribute, the capital gain gets distributed to the beneficiary, right? And it's the same based on whoever the legal owner is if it's a person. So if it's a person, that capital gain falls in their name as well. And the way capital gains basically work is that the person who owns it is who actually gets the capital gain. On that basis, you probably want to think about in the future, like in 10 years' time. If you know in 10 years' time you're on a high income, you're going to retire and then your income's going to go down, maybe holding your own name is okay, especially if it's going to be negatively geared to start with. But you've got to have a little bit of a crystal ball and predict what is going to happen to go, well, this is where I'm going to put the property. But the other thing as well is owning the property in your own name. If you're only starting out, probably what I would suggest is you want to keep it really simple. And you want to be probably just put it in your own name, because the reality is that apart from your own property, there is a threshold on how much you pay land tax on, but generally most people in Australia, their primary residents not going to pay any land tax on. And I'm particularly focusing on New South Wales because that's where I'm at, but every state is pretty much the same like that. But when it comes to, say for example, owning property, there is a threshold that the value that needs to get to before you start paying land tax. And if you're only just starting out in owning property, I would suggest that probably keep it simple and just own the property in your own name. And then when you get to the point where you're actually in a position where finances are looking really good, then maybe you look at a discretionary trust. But I would suggest you keep it really simple. Lastly, I would also say, some people might be saying at home, can I own it in my company? First of all, if you've got like a trading company, like a trading business, don't ever put like an investment or property in that trading business. Because if the trading business goes wrong, and when I mean a trading business, I mean a business that earns you money. That could be like, maybe you own a cafe, maybe you're a plumber, maybe you're a builder, maybe you're an accountant like me. You wouldn't ever put a investment in your business account or in your business company, business entity. But generally speaking as well, you don't want to own the property in a company either. And the reason that is because a company doesn't get the discount on capital gains. And so when you go to sell, so if you own the property in a company, there wouldn't be any discount. But if you own the property in your own name or a trust, effectively, once you've owned the property for more than 12 months, you get what we call the 50% discount. So that means that whatever money you've made, the sale price less whatever cost it did to acquire it and hold it, less the actual purchase of the property, that is your gain. Only 50% of that's going to get taxed. So you've got to be really smart about who should be the legal owner, and it's really important to think about it and work out what's best on your personal scenario, and also thinking about what is going to happen in the future. You need a little bit of a crystal ball, unfortunately, and predict on what's going to happen to then work out what is the best situation that suits you. Let's talk about income and expenses and how it all works in your tax return. So in a nutshell, it's really quite simple. You'll have an agent where, in most cases, you don't have to have a real estate agent to collect the rent, but in most cases, most people do. And the agent will give you a rental summary, which has the total rent and expenses for the year. So very generally, the rent that you've collected goes in as income in a separate rental schedule in your personal tax return, or whichever entity that owns it. And then what we also look at is what expenses are tax deductible. So very commonly, expenses that you would likely to see that are tax deductible are like council rates, water rates, strata fees, if it's a strated property, like a unit or maybe a townhouse, something like that in a complex. What's also tax deductible is insurances on the property. There could be other expenses that, to generally keep it deductible. But a few things that you need to be aware of when it comes to your loan that you have. So if you're paying back principal and interest, it's not the loan repayment that's tax deductible, it's the interest on the loan. When you go and buy the property, there's going to be a lot of costs that you're going to have to buy the property. For example, you're going to have probably legal fees, you're going to have maybe stamp duty on buying the property, and even if we go back to my first point, you take up my advice of getting a buyer's agent, you're going to have those fees. Now, generally speaking, those fees are what we call capital in nature. So that means that those expenses, they aren't tax deductible, but they add towards the cost base of buying the property. So when you go back to our capital gains that we were talking about earlier, the cost of the property is the actual property purchase itself, it's the legal fees, it's the buyer's agent, any stamp duty, and we put those costs together and that is what is the cost of the property. But they are not tax deductible in your tax return. They're not going to reduce the rent. This is not what we're going to put in the return. It's the interest component which is tax deductible. If you put a family member in the property and you give them a discount on rent, let's say for example you got maybe your son or daughter, they're wanting to move out and they want to rent a property and you go, hey, you know what, I've been thinking about buying a property in the local area anyway, how about I'm going to buy a property and you can rent it off me, and what you might do is you say, hey, the market rent is $1,000 a week, but because you're family and I want to look after you and give you that head start in life, I'm just going to make it $500 a week. So that would be essentially a 50% discount. Now, what happens when you do that is that the rent you're putting in is only going to be 50% of what the market is. So you wouldn't be then able to claim 100% of what all the expenses are. What you do need to do is you'd only be able to apply 50% of those total expenses as a tax deduction. Other things to consider with your income expenses, and especially other things that you can do to reduce the income in that rental property. Now, depending on what property you've bought, if it's under 40 years old, I often refer my clients to duotax. So duotax basically licensed to prepare depreciation schedules. And what a depreciation schedule is, with these guys here, they are tax agents as well, just like me, but all they do is prepare reports on what is the value of the property and the items in that property. So that could be anything from the building itself to also other smaller items in the building. Say, for example, white goods like a dishwasher, or it could be carpet on the floor. So they look at all that sort of stuff, and what they do is they put together a report that works out how much of that decline in value year after year can then be claimed as what we call depreciation, which is just an item that then we can go and put in as a tax deduction. So that's an extra tax deduction that you can look at when doing your rental property. And the best part is, I often say to my clients, we often have a look at the property. So the newer the property, the more value, the probably more reality or likelihood that a depreciation schedule is going to be worthwhile getting. Whereas if we've got a property that's probably over 40 years old, it's probably very unlikely it's worthwhile getting. And the reason I say 40 years is because there's a capital component on the actual building itself that then gets depreciated, and it's only the first 40 years that you can typically write off or depreciate. So what I do say to a lot of my clients is, what you really want to do is you want to go and speak to duotax and have just a conversation with them. They'll be able to have a look at roughly the pictures that the real estate agents put up when they've sold it, and then give you a bit of a guidance based on what's in there and what's happened to the property. So even if, say for example, it's a property that's over 40 years old, there might have been a renovation that's done to it with the kitchen, the bathroom, maybe it's a completely new property inside. It's still worthwhile talking to duotax and saying, well, this has happened, even if you didn't do the renovation in the property. Maybe it was the previous owner that did it, but maybe there is also still value in that they can write off as depreciation that then makes it valuable to go get a report done. So getting a depreciation schedule it's a really simple thing. They usually cost around about $700-800 per property, and that cost is also tax deductible as well. The other thing as well when it comes to investment properties and just extra tax deductions is getting a really good understanding between a replacement versus an improvement of a property. And the reason I talk about that is because they're treated two different ways when it comes to an investment property when it comes to tax. So if we look at, for example, a roof, and I have a colour bond roof, and I have one patch of that roof that needs to be, one sheet needs to come out, we've got to put a new sheet in because it's rusted or something like that. That is a repair, and that repair can be tax deductible. But say, for example, you were to change the whole roof maybe because it was falling apart and just was no good anymore and it was leaking and rusting or whatever, and you replace the whole roof, that has to be capitalized. And what that means is it's got to be depreciated. And because it is a capital item, it would be depreciated over 40 years. So it's very important that when you buy a property, and maybe you've had it for a few years, having a look at these repairs that need to be done and saying, do I want it to be a repair or do I want it to be a replacement? Because a repair is always going to be 100% tax deductible, whereas a replacement is going to be claimed over time. So having a good understanding about that is going to help you as well get more deductions in your rental property and probably have a little bit more of a tax benefit for you when you go to lodge your tax. So that is a rental property. That is rental properties and buying in a nutshell. So if we go back over it again, remember, point one was buying the property initially, getting a good buyer's agent and getting your mortgage broker, speaking to those guys first before you even go and do anything. Understand the market, understand what you can afford, and then go there. Next thing is understanding negative gearing. We've understood what the difference is between negative gearing and positive gearing. My advice is, or my opinion, and remember opinions are like assholes, everyone has one, go for a positively geared property or something that's at least near close towards getting to that point. Who should be the legal owner? That depends on your circumstances and you really need to understand what they are. And once you understand them, it's really about reaching out and speaking to your accountant, who's part of your dream team when it comes to buying the property, to help work out who should own it. The next thing is getting this understanding of income and expenses in the tax return and maximizing it to get the tax deductions, understanding how it works in your property and just remembering that it's not the loan repayments that are going to be tax deductible. Once you've got all that stuff together, go and find the property, and you know what, if it's the first one, buy in your own name, probably keep it really simple. And then when you start buying a few more, then you maybe look at something like a discretionary trust. And also considering what state you're in and where you're at. That's everything I got on rental properties. You probably have a lot more questions. If there's a particular topic or area you want me to dive into, or maybe you wanted me to dive further into a particular area of property, let me know. But stay tuned and let us know what you think. And if you like this video today, give us a thumbs up. And you know what, if you know someone who's thinking about property, send them this video, send them this link so they can get some valuable information in as well. Well guys, thank you for tuning in. My name's Nathan Rigney, I'm the Profit Generator. See you guys.